Hello and welcome back to the channel. So I'm in London now, and I've noticed that there are some parallels and some differences between the Australian and English property markets. I'm going to focus on England and Australia today. My name is Steve. Spent most of my life working in the financial services industry, advising people one way or another, and I'm here now to help you. So here is what has struck me. In London, where I am now, property prices are falling. They are also falling right now in Sydney and Melbourne, whereas in my home city of Adelaide, prices are still climbing, albeit a little slower. And here in England, in the Midlands, prices are still climbing in some places as well. So looking at the Australian Totality Index, as at the 30th of July, when I wrote this, Sydney house prices are down 1.7% across 1 year, and Adelaide prices are up 10.9% across 1 year. Across the quarter, Sydney prices are down 3.7%, and Adelaide prices are up 0.3%. As of June, the median house price in Sydney was 1.4 million, and the median house price in Adelaide was 1.02 million. So not an enormous difference in the nature of the cities. Looking at England, in London, prices have fallen across the year by 0.3%, whereas in the northeast, they've risen by 3.5%. So the divergence between London's softening housing market and the steady price growth across the rest of the England, particularly in the northern regions, it comes down to a mix of mortgage sensitivity, extreme price caps, and shifting investor dynamics. While London house property values have trended downwards, down roughly 3.7% year on year, driven heavily by inner London flats, regions like the northeast have gone up 5.9%. Yorkshire and Humberside and the northwest continue to outperform. Primary drivers behind this regional split include the regional rate affordability ceiling. So when mortgage interest rates sit around 4.5% to 5.5%, higher borrowing costs hit expensive markets like London, exponentially higher. So in London, with average house prices around £550,000, a buyer takes out an 80% mortgage, they need to service over $440,000 in. Even a modest bump in interest rates adds hundreds of pounds to monthly repayments, causing buyers to hit an absolute affordability ceiling. Whereas in regional England, average prices are sitting around 140 to 210,000 pounds in northern regions, and the total debt burden therefore was much smaller. So buyers can absorb the interest rate fluctuations. Secondly, landlord sell-offs and low rental yields. So London has long delivered very low gross rental yields, 3 to 4%. And so investors rely on capital appreciation. So what's happening now is there's been tax and regulatory shifts. So higher mortgage rates, changes to stamp duty surcharges, the phase out of what we call non-dom tax status, so people aren't domiciled here, and tighter renting regulations. Many buy-to-let landlords are exiting the market. There's been a supply surge. So as landlords sell off inner city flats, the influx of inventory pushes purchase prices down. And investor capital migration. So landlords seeking income are redirecting capital to high yield regions of the Midlands and the north, where gross yields of 7 to 9% are common in cities like Sunderland, Liverpool, and Middlesbrough, adding further upward price pressures in those areas. 3, the post-pandemic work patterns and space premiums. So although hybrid work models have stabilised after COVID, the structural desire for bigger living spaces remains pretty important. And the price per square foot in London makes upgrading from a flat to a family house super expensive for middle-income households. Buyers are continuing to relocate to regional hubs or commuter belts in search of larger homes with gardens, driving strong localised price growth in northern and towns. And number 4, disproportionate stamp duty and transaction costs. Because stamp duty land tax, it's calculated on a tiered basis. And so a buyer purchasing an average home in London faces tens of thousands of pounds in upfront tax alone. In lower price regions, a far larger percentage of transactions fall beneath or near initial tax thresholds. So that lowers the barrier to entry. So they're not paying much stamp duty at all. Yeah, so when I'm in the gym, I often see a show called Homes Under the Hammer. It also runs in Australia sometimes, but it seems to be a bit delayed there, like a few years old. So there you see mostly Londoners buying much cheaper homes in the north, fixing them up and putting them onto the rental market. There's just a massive difference in pricing. I also see that London is actually losing population, whereas the rest of the country is still growing. This is partly because the government has been cutting back strongly on immigration. Now in Australia, this fall seems to have been triggered by the announcement by the government budget of a change to the treatment of capital gains tax for existing homes. 50% discount will be lost going forward. And also the loss of negative gearing for existing homes. So this is a negative gearing, by the way, is where you can offset your annual property losses against your other income, often your employment income, and indeed for other assets that aren't. For a long time, prices in Adelaide were a lot lower than in Sydney and Melbourne. This has now closed this gap. Indeed, Adelaide is one of the more expensive places to buy a home in the world, if you look at it in terms of the local people's purchasing power, so how much they can spend, their income to the purchase price. So it's very high because people in Adelaide earn less than Sydney overall. So the contrast between Sydney's softening market and Adelaide's continued price growth just shows a classic two-speed housing market driven by, again, affordability limits, housing listing supply, shifting investor strategies. So it also says here that, recent market data shows Sydney house prices declining, down around 3.3% quarterly as the city hits a clear affordability ceiling. In contrast, Adelaide house prices surged 4.8% over the same quarter to record highs. So it's even higher now than Melbourne, which is amazing. So again, comes down to 4 core drivers: the borrowing capacity of people. So Sydney, you're looking at a median house price of 1.73 million, and that's really driven down auction clearance rates. Whereas Adelaide, it's still relatively affordable. It was much, much more affordable years ago. I think people are re-rating Adelaide now. Also, there's a lot more inventory coming on the market in Sydney, and there isn't so much inventory in Adelaide. So buyers are competing for available stock. And also, buyers get a better yield. So the yields remain low in Sydney and relatively high in Adelaide. So if you're an investor, say on the East Coast or Sydney, just as you're a London investor, you're going to go to these more regional markets like Adelaide. Yeah, so, and also it could be argued that Adelaide's entering a growth acceleration later in the cycle, and that's driven by population growth, lifestyle migration, and just not enough housing completions. Now, I personally think that Adelaide is actually being re-rated by people. It's now considered much less like it's getting a much better reputation, and it's inexpensive to live. We've got great beaches there. So yeah, it's just a much, much nicer place to live. Yes. So really, I see a lot of overlap where I think Sydney and London in particular have just become way too expensive, and the regional England and regional Australia are really quite affordable. I think in the UK, there's also quite a big difference in stamp duty. And I think the other differentiating thing is that in Australia, we've had this massive change with the capital gains tax. And I think that you can't ignore investor sentiment in these things. I think investor sentiment is very important. And that's the thing I would say is I think investor sentiment is also very important in the UK. I was having coffee with some people the other day and they were saying, there's just a lot of uncertainty here. There's a war going on in Europe. People know that we have a new prime minister here. People know they have to be spending more money on defence, and they probably have to increase taxation. So where is it going to come from? I think there's a lot of uncertainties here in the British market. So I'm personally very bullish in the long run on this country. It's a great country, but I can also understand why people are feeling a bit leery, particularly about spending the big money here in London. So I think, yeah, timing and investor sentiment is super important. So what do you think? I'd really like to hear your comments below, and yeah, and I just want to wish you all peace and love.